And then the rest of page 4-14, talks about the other types of bonds. You might want to make sure there is a combined performance and payment bond, maintenance bond, supply bond. I'll let you read that on your own. Okay, on 4-15, you have these 3 C's of underwriting. Okay, so what this means is a bonding company, when they're deciding on if they're going to bond you, they're going to look at your character. Okay, that's pretty well, self-explanatory. All right, are you a good actor in the in the industry? All right, got a good reputation. So that's your character, your capacity. Okay, do you have the experience? All right, are you able to do this job that you say you're going to do? And then the capital, do you have the money to do it? So look at the 3 C's: character, capacity, and capital. That's what they call it, 3 C's of underwriting. Now, what they're going to require on 4-16, if you're trying to get a bond, they might want to know a little bit about the financial status of your company. And it says on 4-16, about 4-16, this is page 4-16, halfway down, a little bit further than halfway down, it says financial statements. Financial statements can be prepared under 3 methods: your audit, review, or your compilation. The audit is the most expensive. It's more detailed. Your review is less comprehensive. It says it requires a CPA and so forth. And then you have a compilation. Okay, you just want to show you some numbers. All right. Now, also, the bonding company on page 4-17 is going to look at some ratios. They're going to look at the numbers on your accounting information. All right, and they compare numbers and they come up with ratios. So let's see. I'm on page 4-17. I'm about a third of the way down the page, and I'm talking about ratios. Underwriters use various ratios in determining the liquidity of the contractor. All right. The rule of thumb is used to ballpark an allowable bond program. The contractor's net quick, okay, so they call this thing a net quick, times a factor of 10 will approximate the program allowable by surety. Net quick is cash, accounts receivable, plus cost in excess of billings and estimated earnings minus all current liabilities. Okay, so it gives us an example. Contractor's cash, receivables, cost in excess of billings, estimated earnings, total $1 million. Minus our current liabilities, $400,000. The difference, $1 million minus $400,000, equals $600,000 net quick. So they multiply that times 10, and they say, okay, you're bondable at $6 million. You can purchase a $6 million bond. This is a 10% case based on net quick, it says. Okay, so you might have to do a little math on that. That's a real simple math question. The next math question we're going to talk about is relatively complicated. Go ahead and stop that.